Everyone's celebrating the Fed's potential rate cut here in September, but there's a silent crisis brewing beneath the surface. Let me show you what I mean. I'm Grady Cool, CEO of Cool Wealth Management. Right now, the Fed is deciding whether to lower interest rates, but there's more to it than just making borrowing cheaper. It's a signal about where the economy is headed and what that could mean for your investments, your savings, and even your day-to-day life. Let's break down exactly what's on the table and why it matters. There's been pressure on the Federal Reserve to lower interest rates over the past several months. Heck, you could even say over the past couple years. Basically, as there was inflation, there was this massive rise in prices. Fed increases interest rates, slowing down the economy. Well, that's not really great for investment portfolios, even if it makes it so that the economy is less likely to explode. Now, part of what's going on is you have parties like the federal government itself. No matter what party it is, whether Democrat, Republican, both sides usually want to lower rate cuts while they're in office so that they're able to get the economy to speed up. This looks better for them overall, basically no matter what. When there is a larger supply of money, the economy tends to go vroom. Beyond this, you have bullish investors who are constantly looking to have higher returns on their investments, mainly in the form of the stock market, but when you can borrow money cheaper, this means that the Federal Reserve is then making it so that you can be putting more into investments. So you have multiple parties that are putting pressure on the Fed to decrease interest rates, but you have the Fed who is concerned about inflation. Thus, you have kind of this back and forth of, can we speed things up, or are we going to cause more inflation, causing another cycle of things? Now for the Fed's perspective. They want to make sure that unemployment and inflation are in line. Part of why they control the money supply is to be able to help those two statistics. Unemployment, on the surface, has been pretty good. I mean, it's been hovering around 4%, plus or minus, few basis points for the past few years. Ever since there was 2020 incident we cannot name for reasons I still don't understand. But past 2021, things were looking a little bit better. A little bit of a spike in 2022, but still, things look fairly decent right now. When you go beyond the surface level, though, it doesn't look as good. Meaning, you look at May and June job numbers, they overestimated by 258,000. There are several news stories talking about how the numbers are kind of being messed with, and even President Trump was a little bit angry about there potentially being some political nature to some of this. I'm not going to touch any of that. All I'm going to say is that it's not a good sign if the main growth for those months just disappears and you're basically just left with pretty much flat. That's really not a good sign typically. Going beyond the numbers, I've talked to several people that have really struggled with finding a job even when they're qualified for some of these jobs. Some of this has to do with a lot of the inefficiencies around the job market and AI these days, but when you have qualified candidates unable to find a job for several months, meaning my brother graduated in computer science, had above a 3.7, had internships, couldn't find a job for over 6 months while applying to many every day. Have friends, very similar situation. And you could say that this is just a part of the economy, but when you have qualified candidates being unable to find a job, it usually speaks volumes about what is going on, and it's confusing when the numbers look good. A piece of this could be underemployment. A large part of our economy is starting to be people who are self-employed with things like this going on, and there's also people who are doing part-time work. Think of someone driving Uber, technically employed, but that's really not a viable long-term career compared to someone who's getting some sort of education and then picking up some sort of trade, whether you're a garbage man or going to be the CFO. Either way, that's still going to be better off than working 20 hours a week at a job that pays close to nothing. Or they pick up some sort of starter job and then they're never able to really go beyond that. The fact that the Fed is looking at rate cuts while unemployment numbers are fairly good indicates that they might be starting to be aware of some of what's going on with this layer of underemployment that seems to be happening. Part of a bigger issue with this is when you are underemployment and you pair it with wages haven't been keeping up with the increase in prices from inflation. There were some pay increases, don't get me wrong, but a lot of them were 5% or under. I know for me personally, I was absolutely psyched. And outside my first job out of college at Vanguard back in 2021, I got a pay bump from 43K a year to 48K a year. It's like, woo! But if it was underpaying in the first place relative to 40 years of wage growth, that doesn't solve the problem. And that's the situation that a lot of people are in. Now, does this say anything about the economy at large? And honestly, this is going to be more speculation and more my opinion than it is necessarily set stone fact. But yes, personally, I do think it is a larger sign about the economy. There are a lot of changes going on where people are finding ways to get work, but it's not your typical standard career that's working out. There's a lot of rage against large corporations and the level of control over things and how people are being treated. And I don't think that's going to stop anytime soon. And I think the fact that the government is starting to see some of that and make changes in ways that indicate that they might be giving into some of that isn't necessarily a bad thing. But I do think that interest rate sitting at 2 or 3% indefinitely is not something that we're necessarily going to come back to as the norm. So where that balance point can be found, it's going to be a little difficult to see. There is still the larger question of what this means for your particular investment portfolio. If interest rates are going to be coming down, there are two things you should expect. One, if you're someone who's been holding on to bonds, you will see an increase in prices from your bonds. As interest rates go down, there will be a spike in bond prices. Trying to predict too much around this can be dangerous, meaning let's say the Fed cuts rates by 25 basis points, which is a pretty standard amount. That's not going to see a massive spike. That's going to be just a little bit that you see. The other thing, the economy should start to speed up a little bit, but if the economy's already been struggling and maybe that hasn't fully unraveled yet, it's possible that these things are offsetting as factors. But generally speaking, you could see a pickup in how investments are doing if these two things are offsetting each other a bit. So, does it make sense to go out and massively change your strategy based on the Fed potentially cutting rates? Probably not, but it is a good thing to keep in mind as you're pushing towards the long term. And if there are any massive moves you're making, maybe you're getting a lot of loan to get a house, business, whatever it might be, then it might be worth considering, could I get better financing in, 3 or 4 months from now? It's fascinating to look at what the Federal Reserve is doing and how that might impact different areas of the economy and some of what that says. Let me know down in the comments section, what do you guys think of what the Federal Reserve is doing, and do you think a rate cut really will go through in September? Other than that, I hope you guys enjoyed, and I will see you in the next one. Bye!